As the miners deliver their final wage offers and warn of job cuts that go into the thousands, Gunther Deutch takes a closer look at how the falling commodity prices have impacted on the books of mining firms.
Since August 2011, the platinum price has fallen by over 50%, and this year it went below a critical $1,000 per ounce, a level many regard as break-even point. On average, the price is still somewhat higher, but the outlook is bleak, and an average of below 1,000 is most likely by end of this year. This means revenues, which were somewhat steady over the past few years, are likely to drop dramatically. And as operating costs continue on an upward path, the bottom line will not look good for the foreseeable future. Meanwhile, platinum miners have piled on the debt. And this means that as revenue sinks and debt rises, total debt as a percentage of revenue is going to look even worse than now. Place this in context of consistent double-digit Eskom price hikes, higher wage bills as unions dig in their heels, and falling demand as platinum recycling and slow global economic growth kills demand for new platinum, and one may even be forgiven for thinking that platinum mining in South Africa is close to broke. Meanwhile, the gold sector, which has survived many obituaries already, looks to be in a similar dire straits. After rising steadily, the average bullion price came tumbling down about 3 years ago, and it showed in the top line for gold mining companies. And even though rising operating costs broke trend in between 2013 and 2014, profit margins could not recover sufficiently, remaining non-existent at end of last financial year. This was really because total debts have more than doubled from 2011 to 2014. And debt as a percentage of revenue was almost 200% at last count. So, no matter which way you slice it, gold and platinum mining cannot afford any more cost hikes, and certainly they cannot cope with a lower price for their goods. Gunther Deutch, SABC News.